30 days, not 30 years. Stablecoins, Treasury bills, and the separation of money's functions. Summary statement. The world can lose confidence in the dollar as a long-term store of value without abandoning it as a medium of exchange and unit of account. Stablecoins potentially allow the United States to monetize that distinction, converting global transactional demand for dollars into structural demand for short-term Treasury debt. This can strengthen America's funding capacity without restoring its duration capacity. Section 1. There is a tendency to treat dollar dominance as a single thing. Either the world trusts the dollar or it does not. Either countries are dollarizing or they are de-dollarizing. Either foreigners buy American debt or dollar hegemony is ending. But money performs different functions, and those functions do not necessarily rise and fall together. A currency can be extraordinarily useful for conducting a transaction without being desirable as an asset to hold for 30 years. That distinction may become increasingly important to the United States. Section 2. The separation of money's functions. Money traditionally performs three closely related functions: medium of exchange, unit of account, and store of value. The first two naturally work together. A unit of account provides the common language in which prices are expressed. A medium of exchange provides the instrument through which those prices are settled. Together, they eliminate the coincidence of wants problem inherent in barter and allow commerce to move quickly through an economy. These are fundamentally transactional functions. Store of value is different. It introduces time. Someone accepting dollars today as savings must believe those dollars, or assets denominated in them, will preserve sufficient value into the future. From this function comes another important monetary capability: deferred payment. Lending is ultimately an exchange across time. A lender gives up purchasing power today in exchange for principal and compensation tomorrow. The longer the duration, the greater the requirement for confidence in the integrity of the monetary unit, the borrower, and the political system surrounding the claim. This creates an important possibility. Confidence in the dollar's transactional utility can remain extremely strong even while confidence in long-duration dollar assets weakens. A foreign exporter might happily receive dollars Monday morning, use those dollars to pay a supplier Tuesday afternoon, and hold almost no dollar exposure by Friday. That same exporter, or its central bank, may have little appetite for lending the United States money for 30 years. Those positions are not contradictory. Section 3. Enter stablecoins. Stablecoins potentially industrialize this distinction. Dollar stablecoins such as USDT and USDC allow dollar-denominated value to move digitally, rapidly, and internationally. For users primarily interested in settlement, the attraction is straightforward. They obtain access to the dollar's liquidity, pricing network, and transactional utility without necessarily making a long-duration investment in America. But something important happens behind the stablecoin. The issuer must maintain reserves supporting the tokens outstanding. Depending on the issuer and regulatory structure, those reserves can include cash, treasury bills, and other highly liquid short-duration instruments. Consequently, a portion of global demand for transactional dollars can become demand for short-term U.S. government liabilities. That is the bridge. The user wants a digital dollar. The stablecoin issuer needs reserve assets. The reserve portfolio creates demand for treasury bills. The United States has potentially converted the dollar's medium of exchange function into sovereign funding demand. Section 4. Flow is not stock. The size of this opportunity cannot be calculated simply by taking annual global trade and assuming an equivalent quantity of stablecoins must exist. Trade is a flow. Stablecoin supply is a stock. The same stablecoin dollar can settle multiple transactions during a year. If, purely illustratively, $3.5 trillion of annual trade were conducted through stablecoins, and each dollar of stablecoin liquidity turned over 10 times annually, approximately $350 billion of average balances could theoretically support that transaction flow. Velocity therefore dramatically reduces the stock of stablecoins required to support a much larger volume of commerce. The Treasury opportunity depends not on gross transaction volume, but on the persistent stock of stablecoin reserves created by that activity. There is another necessary qualification. Not every dollar migrating into stablecoins represents new Treasury demand. If an investor moves $1 billion from a money market fund already holding Treasury bills into a stablecoin issuer that buys those same Treasury bills, very little incremental Treasury demand has been created. The wrapper changed. The underlying asset did not. The important question is therefore how much stablecoin growth represents genuinely incremental or redirected demand for Treasury bills. That distinction prevents the stablecoin thesis from becoming exaggerated. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 5. What can Treasury do with short-term funding? This leads to the original question. If stablecoins predominantly create demand for Treasury bills rather than 10, 20, or 30-year securities, does that restrict what the federal government can finance? Not in the straightforward sense. Treasury does not generally match individual government projects with corresponding debt maturities. A 3-month bill can finance the same federal deficit dollar as a 30-year Treasury bond. Defense spending, infrastructure, benefits, salaries, interest expense, and other federal obligations can all ultimately be financed from the government's general funding pool. The difference is not what Treasury can finance. It is how long Treasury has secured the financing. Borrow $1 trillion for 30 years, and that principal does not need refinancing for 30 years. Borrow $1 trillion for 3 months, and Treasury soon has to return to the market and refinance it. Short-term demand can therefore provide substantial funding capacity while providing very little duration capacity. That distinction sits at the center of the thesis. Section 6. The stablecoin bid. A large and persistent stablecoin ecosystem could become extremely useful to Treasury. It could provide additional demand for bills used to finance current deficits. It could deepen the pool of buyers available when existing federal debt matures. It could strengthen demand for one of the most important collateral instruments in global financial markets. And all else equal, greater demand for Treasury bills should place downward pressure on their yields. But Treasury could respond to increased demand by simply issuing more bills. Instead of stablecoin demand causing T-bill yields to collapse, an equilibrium could emerge in which greater stablecoin demand is met by greater bill issuance. The result would be an expanded short-term financing channel for the federal government. Yet the liability would continually mature. That creates rollover risk. It also means federal interest costs become more sensitive to prevailing short-term rates. Long-duration fixed-rate borrowing locks in financing costs. Bills continually reprice as they mature and are replaced. America could therefore become extremely successful at borrowing money without becoming equally successful at borrowing it for very long. Section 7. The sovereignty problem. There is also an international constraint. Foreign businesses may find dollar stablecoins extremely attractive for cross-border settlement, while their governments view them differently. For the private trader, the priorities are liquidity, speed, acceptance, and cost. For the sovereign, the concerns include capital controls, monetary sovereignty, sanctions, and control over payment infrastructure. This introduces another distinction. Store of value dependency is dependency across time. Medium of exchange dependency can be dependency across infrastructure. A company might hold a stablecoin for only minutes, creating negligible duration exposure, while still depending upon payment infrastructure capable of freezing or restricting the transaction. That means widespread stablecoin adoption is not frictionless. But neither does it require wholesale dollarization of foreign economies. The thesis only requires meaningful migration of cross-border transactional dollar activity onto stablecoin rails. That is a considerably lower hurdle. Section 8. A different kind of dollar hegemony. The resulting architecture could look strange when viewed through the traditional reserve currency framework. Foreign governments could diversify long-term savings into gold and other assets. Long-duration Treasury investors could demand increasingly attractive yields as compensation for fiscal, inflation, and duration risk. Yet international businesses could continue pricing commodities, invoices, and contracts in dollars. Stablecoins could make those transactional dollars easier to move, and the reserves behind those stablecoins could create continuing demand for Treasury bills. The dollar could therefore weaken in one monetary function while strengthening in another. This is why the distinction between funding capacity and duration capacity matters. Stablecoins do not necessarily restore confidence in America's long-term fiscal position. They do not guarantee buyers for 20 or 30-year government bonds. They do not eliminate rollover risk, and they do not magically transform every dollar of stablecoin capitalization into net new Treasury demand. What they potentially provide is something narrower, but still enormously valuable: a mechanism for converting part of the world's continuing transactional demand for dollars into demand for short-term U.S. government debt. That leaves us with the central paradox. The world does not have to trust America for 30 years to use America's money for 30 seconds. And if the United States can place Treasury bills underneath enough of those 30-second transactions, it may discover a substantial new source of sovereign financing. But financing is not duration. The distinction remains. Stablecoins could help solve America's funding problem without solving America's duration problem. The world may become less willing to lend America money for 30 years, while remaining perfectly willing to lend it money for 30 days.